Good morning, ladies and gentlemen. Welcome to another Zoom conference of MSMA. A sound finance is needed for a sound health for any human beings. The sound finance needs to be transferred to their beneficiary at the end of their life term. Your beneficiary may be your partner, maybe your children, maybe your pet animals, or maybe your charity. But it needs to be transferred in a tax-efficient way. Most of the members in our group, they are in 50s, 60s, and 70s. I don't think anybody will live for 100 years. So time to think about your planning. I hope today's talk will guide you to get the planning moved. I want to quote an incident in Mahabharata. A gentleman asked the eldest son of Pandavas, Dharma. He asked Dharma, "You're doing so much, how long you're going to live?" And he said, "That's a one thing I don't know. The only man who lived for more than 100 years is Bhishma, and he decided his own health. But the rest of the human beings all over the world, we don't know how long we will live. But then when you are sound finance, in a sound health, please plan to transfer your sound health to your beneficiaries." To explain more, we have a speaker today, Ajay Naik from Leicester. Ajay by no means is not a stranger to this group. He was here in September last year, and he explained about financial investments. Now today he's going to cover how to plan for inheritance tax savings and also a few other things. He is supported by his dad, Naren, and he will complete the icing of the cake at the end. Now, Naren wants to talk about half an hour. Then he will take question and answers from members. Please put your questions on the chat box, and we will call one by one. And end of the question, he wants to bring his dad for icing the cake. Thank you. The floor is yours, Ajay.
Wonderful. Good morning, everybody. Thank you, Raju, for that wonderful introduction. I'm not sure how I'm going to match that, but let's see if we can try. Just bear with me as I turn my screen share on. Okay, so hopefully you should all now be able to see my slideshow. If there are any problems, if I can't see the chat function at the moment, so if there's anything urgent you need me to look at, then just wave your hand or something and let me know if that's okay, Priya.
Yeah, sure, will do.
Okay, thank you very much. So inheritance tax planning, it's a very wide area in terms of, we could talk about this for hours on end, but hopefully I'll be able to crystallize the key points for you. Just quickly in terms of explaining who I am and what I do. So there I am there, if you can't see me on the camera. My name is Ajay Naik. I'm an independent financial advisor. I specialize in working with doctors. So people like your good selves, I've been working with doctors for a good 20 years now, providing very specialist financial planning, everything across the board from investments, pensions, insurance, tax planning, and everything in between. So my contact details are there. We'll put the contact details again at the end, should you need to follow up from today's meeting. So first of all, just to explain the firm that I'm a part of, which is called Fairstone Financial Management. Fairstone Financial Management is the largest chartered financial planning firm in the UK. And not to dwell on this too much, but just to give you an understanding of the different kinds of advice that you can get in the UK. As doctors, most of you will be familiar with the likes of Wesleyan or St. James's Place. they are what we call restricted advisors. So they cannot provide the same kind of financial advice as independent financial advisors do, like myself. And the reason for that is that restricted advisors tend to be limited or restricted to the panel of products and services that they can advise or talk about, whereas as independent financial advisors like myself and at Fairstone, we have access to go to wherever we need to generate the best outcomes for our clients. So we have no bias, no constraint whatsoever. We get paid the same regardless of which ISA or savings plan or tax planning solution we put together. So it really is about doing what's right for you, and normally that ends up working out with you having better outcomes. And Fairstone itself, we believe very much on the strength of our clients and our clients' feedback. So you may have come across websites like Trustpilot. We are the UK's #1 rated wealth management house on Trustpilot. We are 5-star rated. And likewise, there is another website called Vouched For, which is the key financial services review site, and we are the top rated firm on that as well. And just in a few weeks' time, you'll be seeing myself and about 60 or so of Fairstone advisors across the UK who are being rated and featured as the UK's top financial advisors in the Times and the Telegraph. As I say, that'll be out later on this month or next month. So today, what are we going to talk about? Inheritance tax is the major topic. Other than that, we're also going to talk about, I thought if we have time, I'll just cover off some of the key changes that were made or announced in the budget just now this week. And Dr. Raju asked me to cover off NHS pensions, again, if we have time, just in terms of some of the key issues you need to be aware of from a tax perspective. And then finally, again, if we have the time, and depending on how long I go on for, I will give you a quick update on the markets and where investment markets are, because they have moved on a lot in the last 12 months. So first of all, let's talk about inheritance tax. So basically, I see this, and as many others do, as the ultimate wealth tax. I mean, as doctors especially, you tend to be 40 or 45% taxpayers, and any income you're earning between £100,000 and £125,000, you pay 60% tax. So, you're used to paying a lot of tax in your lifetimes anyway, and then having worked as hard as you have and sacrificed as you do, I have a huge amount of respect for doctors. The reason why I love working with you guys is because ultimately you're saving people's lives every day, and what an amazing blessing for me to be able to support you guys in at least making sure your money is there for you, at certain points in your life. So it's painful that having sacrificed everything you have, slobbered your guts out, raised your family and everything else, at the point that you then want to peacefully pass on to the next realm, the government would like to take 40% of your hard-earned wealth away from you. So today's about saying, okay, well, what does that really mean in practical context, and how can we plan around that? So first of all, just to explain how the inheritance tax regime works, it is based on your net asset, your net estate value on death, and it's a 40% tax. There is no, by the way, inheritance tax between spouses. So if, for example, in your will, you say, okay, when I die, I want everything to go to my wife, or vice versa, then in that circumstance, there would be no inheritance tax payable. For the purpose of these slides, I'm using the word, the letters IHT, standing for inheritance tax. Now, the good thing is, at least, is that it's not the entire estate that is liable for the 40% tax. You do have an allowance. That allowance is called the nil rate band. And the nil rate band is £325,000 per person. And that can be transferred between spouses and civil partners. So let's say today, if I passed away and I'm leaving everything to my wife, then she will then inherit my £325,000 nil rate band. So effectively then when my wife then passes away, and say at that point she's then leaving everything to our children, then there is a total of £650,000 as the nil rate band. So it's only then the amount above the £650,000 that is liable for that 40% inheritance tax charge. A lot of you will be, if you're in private practice, will have limited companies. Private limited companies. Now, these will actually qualify for something called business property relief, BPR. So as long as you hold any shares that you hold in unlisted trading companies, so for example, your private practice, or if you happen to be a care provider running a nursing home, dental practice, whatever it may be, then those companies and their assets will qualify for business property relief, as long as you've held those shares for 2 years. So at least that's one good thing, that any business assets that you have, there are some caveats that I'll come up to, but generally speaking, any business assets that you have and shares that you own in those will pass along to the next generation without there being any inheritance tax payable on them. The key exclusions to that, however, is any investment companies. So if, for example, you have a separate limited company for tax planning purposes that you've you've been doing investments through, whether that's stocks and shares, whatever, then or holding cash, then they would not qualify for business property relief. So they are included within your estate. And likewise, if you're into properties and you're doing buy-to-let investment for property purposes, normally if you're, because there's a lot of issues around taxation at the moment, there is a growing trend to people now building their property portfolios and buying investment properties through limited companies. Now, what you then have to do these days is the lender will expect you to set up a separate investment company for those properties. It can't be held within your normal trading business, typically speaking these days. So that's what we call an SPV, special purpose vehicle. And so SPVs, investment property companies, in other investment companies, they do not qualify for business property relief. So the key thing there is to remember, if you are investing in property, it will cause you some chaos when it comes to inheritance tax. Not to say we can't plan for them, but it's something you need to be very, very careful of and aware of. Now, there is also an additional nil rate band that was introduced last year, a few years ago, and that's called the residence nil rate band. And the Tories brought this in, George Osborne brought this in on the basis that a lot of people have wealth in their houses. And so the idea was to try and take your house outside of the estate as far as inheritance tax is concerned. So as it stands right now, each person has a £175,000 allowance, what's called the residence nil rate band. And as long as you are passing your house in your will down to your direct descendants, and you'll see there that there is a specific definition for that. So direct descendants basically has to be your bloodline, so your children, your grandchildren, your great grandchildren, and likewise stepchildren, foster children, adopted children, or widowers or widows therein. So as long as you're passing your property down the line in that sense, then the first £175,000 of the property will not count within your estate. So if you then say, okay, well, I've got £175,000 residence nil rate band, my wife has £175,000 resident nil rate band, the total there is £350,000. So in theory, we've got £650,000 of normal nil rate band between husband and wife, and then we have another £350,000 on top of that for your main residence. But obviously the residence nil rate band will only go towards your main residence. So if your main residence at the time of death was worth, say, 250,000, then you only get the £250,000 nil rate band for the residence allowed. You can't use up the full 350 on other things. I hope that makes sense. So in theory, we've got up to, say, £1 million here. Now, that sounds like a lot, and a lot of people may be thinking, well, actually, £1 million is okay. But the facts tell us that the likelihood is that most people in your kind of situation, doctors, people who are used to a certain kind of lifestyle and a certain kind of income, will just naturally not have an estate of £1 million or less by the time you get to death. And as Raju says, maybe you might not live to 100, but we would expect you these days, statistically speaking, if you're 50, 60 years old right now, you should have a good sort of third of your life ahead of you in retirement these days, because as you know, the NHS is very good at keeping us alive. So over that time, and taking inflation into consideration, your estate is going to increase quite dramatically, we expect. Now, the interesting thing is that every single year, we hear somewhere in the financial press mutterings about these nil rate bands, like the 325,000 and the residence nil rate band of currently 175,000, there is always some speculation that the Chancellor is going to increase these allowances in line with inflation or whatever. Many years ago, in David Cameron's era, there was even talk, speculation of the normal nil rate band going up to £1 million. Clearly, that hasn't happened, and we do not believe it ever will happen, because inheritance tax is a very large tax generator for UK PLC, and in fact, in the budget just now, all of these have been frozen. So the £325,000 nil rate band and the residence nil rate band of 175,000, they are now frozen for at least the next 5 years. And in the 20 years I've been doing this, that nil rate band of 325,000 has always been 325,000. In fact, it was actually originally 300 when I first joined the industry, and it's now 325. So you can see there isn't really a lot of scope or appetite for this to increase. So as your assets increase in line with inflation over time, if nothing else, then the inheritance tax problem is only going to compound. And the other kicker is that the residence nil rate band actually tapers down when your total net estate value exceeds £2 million. So for every £2 that your total estate value is above 2 million, then the residence nil rate band reduces by £1. So effectively, as soon as you've got an estate worth of 2.75 million, then you have lost your residence nil rate band altogether. Now, the definition of net estate value is you take your total assets, you take your total estate value, so all of the things that you own, and you take away any liabilities. So for example, if you have a mortgage, you take away the mortgage, and then what's left is then the net asset value. But importantly, you can see there at the bottom point there is that any nil rate bands, any other allowances, any spousal exemptions, any assets that qualify for business property relief are included into the estate for the purposes of this calculation. So if you have a business that's worth £1 million and you have and your overall estate is worth £1 million, well, your total estate value now for this purpose is not $1 million, it's actually 2 million. So as you can see, there are ways of falling foul, and you can lose your residence nil rate band quite easily. So what can we do about it then? Well, there's lots of things we can do. The easiest one is spend it. Now, it's very hard to spend all of your money, but ultimately, the principle is that over a lifetime of working with financial advisors like ourselves, when we are doing inheritance tax planning, and by the way, at Fairstone, as chartered financial planners, we do everything. So, we have qualifications, and I particularly am able to do trust investments and all sorts of other, tax planning. And normally, when you have very large estates, over a few £1 million, it's very hard to completely mitigate all of the inheritance tax. In truth be told, but you can do a really good job. But ultimately, it's not something that happens overnight. It does take many years, and it's got to be a solution that's put in place that year by year you make incremental changes to the estate and implement different kinds of planning as circumstances warrant, so that, say, over 20, 30 years, the inheritance tax bill is virtually eliminated. I mean, you can do it sooner than that. There are ways of doing it quicker. But generally speaking, it's going to be a combination pretty much of all of these things. So as I say, spending it is quite simple. You could take the approach that, well, actually, this is my hard-earned money. I'm going to give some to the kids, but the rest of it, I'm going to spend it on my retirement and enjoying my life and going around the world. But ultimately, how much can you really spend on that? It's always the challenge. The next one then is giving it away. So you can actually gift assets away from to your children and so forth, to charity, etc. You can even leave it to your pets, as Raju suggested. But there are caveats with that as well. So I'll come on to that. We can also put money into trusts, and trust planning is a really key part of this all. We can do inheritance tax friendly investments, and there are certain ones of those which you can blend different requirements. You can also insure the inheritance tax liability. So for example, if we did the calculation to say, okay, well, we know that as of today, your inheritance tax bill is, say, £200,000, and in 20 years, just by simple compounding growth of your assets, we know that it's going to go to £500,000, then we can simply put an insurance policy in place to cover that £500,000, or somewhere in between. And again, I'll talk about that a bit more. But as I say, it normally ends up being a combination of all of these different things, depending on your circumstances. I think the key thing with this is most financial planning, there's not a one-size-fits-all solution. It has to be tailored based on the individuals and what they're trying to achieve. So the first thing about giving assets away is that every person has an annual gift exemption of £3,000. So straight away, you can give £3,000 away as a one-off, or adding up to £3,000 to your children, grandchildren, whatever. It is a total annual allowance, so it's not £3,000 to each individual person. It is just £3,000 in total. So you can give that away anyway, and there's no inheritance tax on that. There are small gifts as well, so up to £250. You can give as many of these £250 gifts away as you like, and they don't count within the inheritance tax calculations. You can also give wedding gifts as well. So if your immediate children are getting married, as long as you make the gift before the wedding takes place, and it has to be the legal actual registry wedding in the UK, then you can give £5,000 away per parent. So for example, husband and wife, your son or daughter is getting married, you can give £10,000 away. In likelihood, being an Indian, the wedding, I'm sure, is going to be costing you a lot more than £5,000 to £10,000. But at least, that bit is inheritance tax free. If you're giving money away to your grandchildren for wedding gifts, then it's £2,500 per spouse. And if it's to anyone else, like a friend of yours is getting married, or one of your nieces or nephews or someone like that is getting married, then it's £1,000 is the gift allowance. You can also, though, give away as much as you like out of your surplus income. So the key test here is to say, let's look at your income coming in each month. And if there is a natural surplus there, and you're giving that away without you having any negative impact on your livelihood and your state of living, your standard of living, then that can also qualify as gifts. So this is where it becomes a bit tricky, because as doctors, typically husband and wife, both doctors, both consultants, you can easily have a good £10,000 a year, a month minimum, left over each month after paying for all your bills and everything else. Giving away 5,000 of that each month to your kids, yeah, it's possible, and you could argue that, and that is something that we do consider. But if you're suddenly giving away a £30,000 or £40,000 gift in one go, because, for example, you're helping your children to put a deposit down for a house, then that would not itself qualify within that surplus income exemption, because it's a large lump sum you've given away in one go. So again, you've got to be careful with that, and this is where advice is really key. The key thing, though, is that if you're not benefiting from one of those allowances, anything else that you're giving away, absolutely, to that individual. So, for example, I'm helping my son buy his home. He hasn't got enough deposit himself, so I'm going to give him £100,000 towards that deposit. Well, that is what we call a partially exempt transfer, a PET. And a partially exempt transfer is where effectively, as soon as that gift has been given to that person, then there is a 7-year clock that starts. And so over that 7-year period, effectively, if you die within that 7-year period of making that gift, then some of that, if not all of it, is on a sliding scale, is counted back inside of your estate as if you'd never given that money away. So that's something we have to be really careful of when we're making gifts, is that, we've got to survive 7 years for it to be outside of our estate. Now, if you are planning on making gifts, then again, it's very worthwhile talking to an independent financial advisor like ourselves, and talking through the scenarios, because there could be different ways of doing that. And there are, and again, there's planning we can put in place to mitigate potential inheritance tax. But obviously, the key thing is with giving money away, the sooner you start doing that, the younger you are, the likelihood is you're going to survive that 7 years in theory. But of course, as we know, no one knows for certain what's around the corner. COVID certainly has taught us that. The final thing then with giving money away is that you can make donations to charity. It has to be a registered charity. So any donations that you make outside of your estate, any donations you make to charity, they are automatically exempt from inheritance tax. There's no survival period. They are exempt. And if you do have a very large estate, and one of the things that we do talk about to our clients is actually, if you can afford to do so, and it's not going to have a huge detriment to your children, then you can actually give 10% of your net estate value to charity at the point of death. So that's what we call a legacy. And if you make a legacy donation of 10%, at least 10% of your estate, then that actually reduces your inheritance tax rate for the rest of your estate from 40% down to 36%. Now, when you're talking large estates of $1 million plus, then that's, it's a considerable amount of money that you're saving. So it's worthwhile considering. So that's generally speaking, giving money away. Now, the problem with giving money away is that, of course, you don't have any control over that. Once you've given that money away to whoever it is, there's nothing you can do to get it back, in theory. So it's a conversation we have regularly with our clients to say, okay, well, as part of the overall inheritance tax solution, we're going to start giving money away to our kids. And that's fine, if we're willing to accept that there's that 7-year survival clock. But the issue, there are several issues with this, is one, you don't know ultimately, once that money has left your bank account and it's now in someone else's bank account, as much as you trust your children, and I'm not suggesting that your children would do anything untoward with this money, but there is always a risk that that money will not be spent in the way that you intended it to be spent. So for example, and one of the common ones we see is marital breakdown. So if there is suddenly a marital breakdown, and let's say you've now given £100,000 to your son or your daughter, and his or her marriage is now broken down in the future, well, now that's the spouse of your child now has a claim on that money, and so it's no longer theirs. Equally, there can be other problems. We have occasionally come across issues where, it's sad, but people get into financial difficulties. It could be that that person you gave the money to was running a business, and they got into difficulties with their business, and they were giving personal guarantees, whatever. So now all of the money that you gifted them is at significant risk. The key way of dealing with that is to use trust structures. Now, trusts in themselves are very complicated legal arrangements, so it's beyond the scope of today to go into huge depth with this. But the key thing is with trusts is there are different kinds of trusts. There are what we call absolute trusts, there are discretionary trusts. And the key thing with trusts is it gives you, the donor, complete control. So you can control how the money is distributed, when it is distributed, how the money is invested during that time, and equally who gets what out of it. So during your lifetime, the money is still under your control. It's outside of your estate. So, you've gifted a large amount of money outside of your estate. So, potentially there's no inheritance tax on that now. But at least you've got control. You can determine when money is distributed and how it is distributed. Now, you can even create trust structures where the money actually gives you some benefit at the same time. So you're giving the money away, but you can take income from the trust. So you're not actually losing the benefit of the money in that sense. So we do this quite often to help fund other lifestyle requirements, or indeed to fund other parts of the overall inheritance tax solution. So it's a good sort of halfway house to say, okay, well, I'm going to give the capital away, but I'd like to continue receiving the income. Likewise, we can gift monies into the outside of our estate and into trust, because essentially a trust is a separate legal entity. And then at the same time, you can keep control of the capital, but any growth is then free of inheritance tax. So there's different ways of skinning that particular cat. And as I say, it's really about giving you control and giving you discretion as to how monies are distributed. The key thing to remember with trusts, though, depending on what kind of trust it is that there can be tax implications in terms of initial, ongoing, and exit. So this is where, again, you have to be very careful. You have to get really good, sound financial advice from people who really know what they're talking about with this stuff, because it is a bit of a minefield. We can mitigate tax in a very specific way, and that is all done legally and all HMRC approved. However, you've got to get the right advice for it because it is a very complex subject. People often ask me, well, what if I just put my property into trust? Well, you can do that. However, there are implications in terms of taxation as well, because trusts do pay the very highest rate of tax. So as an individual, you and I today, we have a personal allowance of £12,500 a year before we pay any tax. Trusts have a much lower, about just over £1,000 personal allowance, and we as individuals have income tax thresholds of or rates of 20%, 40%, 45%. Trusts just pay 45%. So again, putting things like properties with rental income and everything else, it doesn't make sense to do it during your lifetime. Normally, it ends up being a hugely expensive and actually completely destroys the tax benefits from the inheritance tax perspective, because it costs more in tax during your lifetime. So you've got to be careful of what you put into trust. Fortunately, we do have very specific tax wrappers where if you're putting cash into a trust and you're putting that into certain investments and generating income and that sort of thing, then we can do that in a very, very tax-friendly manner. And there are tax wrappers specifically designed to help us do that, where you don't suffer those kind of tax charges that I've just highlighted. So we can make it work to your favor, but not really for property and things like that. There are other forms of inheritance tax-friendly investments as well, as I say. So it's not just about trusts. There are specific business property relief, BPR investments that you can do. So as I say, one option is you can set up a business yourself. You have your own trading business. The shares of those typically will qualify for business property relief. So as I say, as long as you've held them for more than 2 years, they're outside of your estate. But there are BPR investments as well. So there are specific funds and fund managers that run inheritance tax solutions. And with these, what they tend to do is they tend to invest in the AIMS market. So you don't get BPR for the main listed stock exchanges. So the typical investments that are on the FTSE 100 or S&P 500 or whatever it may be, those investments, they do not qualify for business property relief because they are proper publicly listed companies. However, the secondary listing market called the AIMS market, they do qualify for business property relief. Now, the only downside of that is that the AIMS market, by its nature, because they are smaller companies, I mean, they're not small private limited companies like your own private practice, they're bigger than that because they are listed, but the overall marketplace is quite small. It's it's only a few hundred, a couple or 300 companies, as opposed to the thousands that you can get on the main stock exchanges. So the investment universe is more narrow, and that ultimately also means that your risk increases as well. So it's not for everyone, and we tend to see it from a more sort of later life planning style, because you only have to live for 2 years. So quite commonly we see, we advise this for people in their 80s and 90s, where they've got a large amount of money, it's still in their estate, they've had all the benefit that they were going to get out of it. Now they're towards the very latter stage of their life. We've put enough money aside just to cover their care costs. Anything else, we can then use things like business property relief investments, because ultimately all they've got to do is survive 2 years, and then the kids are going to inherit it, and it's taken over quite nicely. You can even transfer your ISA portfolios into BPR investments as well. So again, it gives some quite interesting tax planning opportunities as well. The other investment that I'm just going to highlight is enterprise investment schemes. Enterprise investment schemes, if you're on the last presentation that I did last year, I did briefly mention these. These, again, they're higher risk by their nature, but enterprise investment schemes are effectively, they're a very good tax planning vehicle, because you get 30% immediate income tax rebates or tax relief on the money that's going into enterprise investment schemes. So it's very good from an income tax planning perspective. But again, the investment itself qualifies for BPR. So as long as you held the shares for 2 years, then they qualify. Then they're automatically outside of your estate for inheritance tax planning purposes. So again, worthwhile considering. They're not for everyone. As I say, these sort of things, they do represent a much higher risk than your more traditional stocks and shares based investments. But certainly, something worthwhile looking at if we're doing full planning for you. The next opportunity is, and quite often with inheritance tax planning, a lot of people do try and be very clever, and quite often we talk to clients and they say, well, let's do trust, let's do this, let's do that, and they're looking for the most complex solutions. And sometimes, I mean, I'm not saying we don't do that, we do a lot of that, but ultimately, sometimes the very simplest solutions are the best in terms of robustness and actually just doing the job without any tax implications whatsoever. So that's where, let's say, for example, we've identified you've got a £500,000 inheritance tax liability. Well, we can put a guaranteed whole of life insurance policy in place that says whenever you die, whenever that is in the future, this plan is going to pay out and guaranteed to pay out that amount of money. These plans are written under trust. So what then happens is that any proceeds, they don't fall back inside of your estate. So on the point of death, the money goes into a trust structure. Your beneficiaries, your children, etc., can then take that money out without any tax implications and use it to pay off the taxman. And so it's nice and clean from that perspective. As I say, it's risk-free because once the plan is in place, as long as you keep paying your premiums, your monthly contributions, then it's going to pay out that amount. Even if you live past 100, doesn't matter, it will pay out. Now, obviously, the problem with insurance is that you've got to be insurable. So it only makes sense in your, say, up to your 50s normally. We can do it when you're in your 60s, but you've got to be in very good health. And normally speaking, the way we look at it is even if you live to be 100 and second death, both spouses, they passed away at the age of 100, normally, at the very worst case, you're going to double your money. So if, for example, you've got a £500,000 going in, £500,000 payout, then normally the maximum cost is going to be around 250, 300,000, something like that, even if you're starting at later stage. So from that perspective, it's a zero gamble, and you're going to at least double your money on it in that sense. Not that we want to profit from death, but it's one way of looking at it. So again, it's all of these things. They're not a one-size-fits-all solution. We would tailor the solutions based on your circumstances, and there's no bias as far as we're concerned. Our job is to make a recommendation based on your circumstances and put a step-by-step solution in place, which may encompass some or all of these different facets that we've talked about. Now, one thing that we haven't talked about so far is wills. And it surprises me today how many people I come across who do not have a will in place. It's not expensive to get a will. £100, £200 for both of you, husband and wife, to get a will, £300 maximum, that sort of thing, from very good will writers. You don't necessarily have to go to a high street solicitor's firm. They'll charge you double the money for pretty much the same thing. But so it's, it is a competitive market. But the importance with a will is that everything will go to where you want it to go. And this is really, really key for inheritance tax planning, because typically the best inheritance tax planning works in terms of making use of all your allowances is where the first spouse passes everything or virtually everything to their surviving spouse. And then on the second death, when the surviving spouse has passed away, then you cascade the wealth down the generations, with the exception of things like trust-based structures and other things that we would do during your lifetimes. So that only is effective, and that can only happen if you've got a will in place that says, I want this to go here, and etc. If you don't have a will in place, then the law of intestacy kicks in. And the law of intestacy is very clear in terms of there's a very set structure in terms of how things pass down. So it's not a case of, everything goes to my wife or vice versa. Any joint assets would naturally pass to the remaining joint owner. So if you both jointly own your home and you're joint tenants in your own home, that's fine. That's, if husband dies, it's just going to go to the wife automatically because you both own the property. So that's okay. Similarly, with any joint investments you have, they will pass away to the second spouse. However, anything then above, over and beyond the joint assets, it's not clear cut. So the first £270,000 of the estate after any joint assets goes to the spouse. And then anything after that, 50% of it goes to the spouse and 50% of it goes to the children. So if you're planning on leaving certain things to charity, to your pets, to your nephews, nieces, other members of your family, brothers and sisters, whatever, it's not going to happen under intestacy. So you must have a will in place. And as I say, Without the will, you will lose, or very easily can lose, your nil rate band and your residence nil rate bands. Yeah. The other key thing to remember is with wills, a lot of people, and ask yourself this question if you've already done a will, did the will writer or the solicitor put a trust structure in place to go with that? Because quite often, trusts are recommended by will writers and solicitors as part of the overall estate planning. So they may say, put your property in trust. And there are terms like pilot trusts or flexible lifetime interest trusts. There is all these different kinds of trusts. You've got to be so careful with these because a lot of these trusts actually negate the residence nil rate band planning. So, for example, a common one that we've tended to see is the will writer will say, right, rather than you owning the assets jointly, actually split the ownership 50-50, because so you are what's called tenants in common. So you both own 50% of the house rather than you both sharing 100% of the house. And in doing so, when it comes to the point of you needing to go into a care home, the local authority can't value the house because you only own 50% of it. Now, that's all good and well for people who don't have your kind of wealth. But doctors, typically, you're always going to have to pay for your care anyway, because you're going to have more than £23,500 in assets outside of your property by the time you go into care, if you need to go into care. So, all of that planning, in some senses, is a bit pointless. And as I say, the really key thing is that a lot of these trust structures that solicitors and will writers have done in the past will completely negate the residence nil rate band, because remember, the residence nil rate band will only work if you are passing that asset directly to your descendants. So if it's going into a trust, especially a discretionary trust, then it doesn't count. So that's something you've got to be really, really careful with. And again, if that's something that's ringing alarm bells in your mind, then I strongly suggest you get in touch with us and we can discuss that with you and just clarify that for you. I'm not saying every trust that's done under wills is bad, but as I say, you really do have to check it because a lot of them we come across have not been done correctly. The final thing I'll just cover off is powers of attorney. And this is something, again, that not a lot of people I come across tend to have done. People, and as doctors, you probably, if you worked in hospitals especially, you will have probably at some stage signed power of attorney forms because, you've got an elderly person in care and their attorney, normally a family member, will be making or be involved in the discussions in terms of their healthcare and making decisions on that person. So that's what a power attorney effectively does, is it gives someone else the ability to make decisions on your behalf should you not be able to, even if it's a case of temporarily losing compos mentis. Now, if you try and get powers of attorney done retrospectively, it will take about 6 months and it will cost you several £1,000s, or cost the people trying to get the control several £1,000s. So actually doing the lasting power of attorney documentation now, okay, fine, it might cost you £1,000 or so, or a few £100s to get the paperwork done, because there's two. There's one for health and well-being, and there's another one for finances. So there's two different powers of attorney. So between a couple, there's 4 documents you need to get done. But getting them done and registered now, rather than waiting until that point has happened in the future, will save you a considerable amount of money and stress. Because whilst your beneficiaries or whilst your family are trying to get the power of attorney done retrospectively, there is a court-appointed person making those decisions. And clearly, they're not going to be making the decisions based on what you might be needing to do, especially when it comes to moving monies around the estate, because we could potentially be having to do deathbed financial planning or whatever it may be. So that's inheritance tax. I've got a few minutes, so I'm just going to very quickly cover off some of the key things that happen in the budget. It was, to be honest, quite a simple budget. There weren't really any nasty surprises there, and I think Rishi Sunak has done a great job, really, in terms of trying to keep the economy going. And although there was a lot of rhetoric of increasing taxation, he's done a very smart thing politically to say, yeah, we're going to increase tax, but down the line. So he's appeased some of his political peers, but at the same time, he's tried to keep it as fair as possible right now on the basis that the economy still needs some stimulation. And there is a lot of economic scarring working its way through over the next few years. So the key take-home points really, nothing major. The personal allowance, the amount that you can earn before paying any tax, has increased by a whopping £70, and the 40% threshold before you pay 40% tax has increased from £50,000 to £50,270. And other than that, everything has pretty much remained the same. So the 45% threshold has remained at £150,000, and income that you earn between 100,000 and 125,000, you still are paying that effective rate of tax of 60%, because for every pound above £100,000 you earn, you lose some of that personal allowance there. So again, if you're in that boat and you're earning more than £100,000 a year, then get in touch and we can look at how we can plan and mitigate that issue. The other key thing to remember though is, other than that, all of the other allowances were frozen in terms of personal taxation. So capital gains tax allowances were frozen, annual allowances were frozen at the current point for pensions, and also the pensions lifetime allowance, which historically has been going up in line with CPI, and the government committed to that some time ago. That has remained frozen till at least April 2026. So the annual allowance for pensions is still 1.073, not the higher amount that we were expecting it would go to this year. And the other major changes, if you're running a private company, a personal, you have a private practice, you've got a limited company for taxation purposes, then just bear in mind that the corporation tax rate from April 2023 is increasing to 25% if you are showing a profit of more than £250,000. So if you've got a small company and your profit is only £50,000 in a year, then from April 2023, then you're okay. You'll still remain at the current rate of 19%. But anything between 50,000 and 250,000, there will be a tapered increased allowance, anywhere between 19% to 25%. And any profits that you realize above 250,000, there'll be a 25% tax charge on that, corporation tax charge. There may be some planning that we can do around that. In fact, there will definitely be some. So again, get in touch if you think you're going to be affected by that. The furlough scheme, for any of you that are employing people, that is now extended. So currently it's being extended in its full current form till the 30th of June 2021. And then from July up until September this year, they will phase it out. And the stamp duty holiday, which currently says there's no stamp duty on your main residence, on residential properties up to 500,000, that has been extended to the 30th of June. And then after that, it's going to reduce down to £250,000. Remember, if you're buying a second property, so if you're buying an investment property, then the stamp duty surcharge of 3% will still apply, even if you're buying a property less than £500,000 or 250 from September. So that's that. I'm just going to, Raju wanted me to talk about pensions and just quickly cover that off. Raju, have we still got time for that, or would you like me to move on to questions and answers?
I think it's nearly 50 minutes or more, just more than 45 minutes. Shall we take question and answers? I mean, pension, most of our members know about pension. Yeah. And maybe we can keep it for another day. So shall we stop here and take questions? Yeah. Now, before asking the floor, I want to make clear about a few things, Ajay. You mentioned £175,000 and two of the partners is 350 from main residents. Is that right?
Yeah. So there is the residence nil rate band.
Yeah.
And that residence nil rate band is £175,000 each.
But then most of the houses, especially in London and home counties, is around £1 million. So how do we benefit from this?
Exactly. That was the point I was making, is that it was a bit of a gesture for people who don't have large properties. But as you say, if you're in somewhere like London, I mean, up north, you can, even then, clients of mine that are up north, they have houses upwards of, £400,000 or £500,000. So it's it's effectively only the first £350,000 of your house will be exempted from the estate.
Right. So so that means the rest of the valuation comes for tax. Yeah.
Correct.
Okay.
Yeah.
Right. Now you mentioned AIM. What's AIM stand for?
AIMS is the alternative investment market. So normally when you're doing investments, like funds or whatever, or you're buying your own shares, they tend to be listed on one of the major stock exchanges. So for example, UK companies are listed on the FTSE 100 or the FTSE 250, etc. Whereas the AIMS market is like a secondary investment market. It's for smaller companies, much smaller companies that don't meet the criteria to be on one of the major stock exchanges.
So it's an unlisted company. There may be a risk then.
Precisely. Well, it is listed. It's bigger than your typical company that you work with. So they are still large companies, but yes, compared to major companies that you would normally be investing in, it is a higher risk.
Right. Okay.
And that's why we say it's better to do those things normally later on in your life, when effectively the money is going to the next generation. You can leave it for a very long time and let the markets do their job over many years.
Right. Okay. You said a stamp duty holiday until 30th of June. Does it mean our members who want to gift out properties to the children could be done without stamp duty?
Sorry, could you say that again?
No.
Suppose somebody wants to gift out the property, buy-to-let property to the children.
Yeah, so there's two taxes that come into play when you're gifting a property.
Right.
The first one is as you rightly say, the person receiving that property will have to pay stamp duty normally. So yes, there's that exemption there at the moment because of the stamp duty holiday. But you yourself, when you are giving that asset away, there is capital gains tax payable on that, as if you were actually selling the property.
Right. Excellent.
So you've got to be very clear. You've got to be very careful with that.
Right. Okay. Now, the estate also includes your asset all over the world. We haven't touched on that. Some of our members have asset in India. Do you want to touch, or do you want to leave it to your dad?
No, that's fine. I mean, it's highly complex is the honest answer to that question. The government is now becoming, especially with the move that Modi has made in India with regards to digitizing the financial system there a lot more, it's becoming harder to, in inverted commas, hide assets in India like people were quite used to doing. And so, as you say, Raju, it's worldwide assets. So effectively, as far as I'm going to say as an advisor today, officially speaking, at the time of death, the executors of the estate, when they're declaring everything to the taxman as part of the probate process, it's worldwide assets.
Right. Okay. Right. Before moving to the floor, can I make an appeal to the audience? Ajay has shown his email ID, ajay.naik@fairstone.co.uk. Please send your emails, whether you are going to use him or not. It will be useful at some point, even not straight away. At some point, you need their guidance. So can I request all our members to share your emails to ajay.naik@fairstone.co.uk. I think it's not an unreasonable request, so please do so. Do you want to say anything about it?
Yeah, well, as always, we have a very strong relationship with MSMA, and we are offering every member a free financial review. So no obligation whatsoever. Just simply send me an email, and we can organize a free financial review with you. And if whatever topics you want to talk about, whether it's your NHS pensions, whether it's inheritance tax we've discussed today, investments, whatever it is, we can spend some time discussing that with you. And as I say, no obligation whatsoever.
Yeah, thank you. I think Fairstone is a regular contributor to our group, so let us support them. Thank you.
Thank you.
Now, Sivapriya or Ajay, do you want to take your slide off? We want to see the members.
Yeah, absolutely.
Yeah, thank you.
Okay, great. So there's quite a few. Do you want me to just work my way through the chat? Because there's a few questions that have come in there.
Okay, now we will start off with Viswanathan. The first one is Viswanathan, isn't it?
So there's Gokul.
Yeah.
At what age?
No,
are
sorry.
Children's
Before
eligible.
that. Yeah. Gokul is first. Yeah. Go ahead.
Okay. So the £3,000 per year gift allowance. That's not limited to your children. That's to anyone. It's just an overall. You can give £3,000 a year away to people. There's no age limit in terms of if you're giving it away to children. Yeah. It's any age.
Right. I think I feel I like to see their faces. Where is Gokul?
Oh, Mr. Raju.
Hi. Are you happy with the answer? Where are you? We can't see you.
I am now on the video now.
Okay.
Yeah.
Right.
No, the thing I was asking is if the child is an youngster,
yeah,
he doesn't have any account or anything of that sort. So if you're transferring money to him as a gift, how do we show that, or how do we do that in terms of
record? Okay. Yeah. So if if the child is under 18, then normally you would use children's savings plans, junior ISAs, that sort of thing. From an inheritance tax perspective, the issue is, has the money left my account and gone into someone else's account? That's what the gift is. The taxman isn't looking to say, well, what structure did you then put the money into? It's just a question of the gift itself in terms of that. The other point we would make, though, is we always exercise some caution when gifting money to children under 18, because if you're, for example, using children's savings plans, junior ISAs, things like that, just be aware that when the child turns 18, that money is theirs. So take, for example, a junior ISA allowance of £9,000 a year. And if you do that over 10 years without any growth, your 18-year-old child is now going to receive £100,000 in their hands. And you have no control over that. I personally am not using that for my kids because I wouldn't trust them with that kind of money at the age of 18. It's a very large amount of money, and children that age they don't have the maturity to deal with it. So I'm not saying that you shouldn't do it. I'm just saying you've got to be careful.
Thank you. I think next one is Srinivasa Vishwanathan. Please ask your question. Srinivasa Vishwanathan.
Yeah, I'm just trying to unmute. Can you hear me?
Yes,
yep.
we can.
Yeah, it was just a question about, I think you briefly touched on it. If I inherit estate or money from an Indian parent who lives in India, and if I leave the money there and don't get it back, what are my IHT liability? It's the same as everything else?
As I'm aware, there isn't any inheritance tax you're going to pay when you receive it from your parents. However, if you leave the money in India and then you've passed away, it's still your money. It's still inside of your estate.
If you don't mind, Ajay, I will invite your dad, because your dad moved from East Africa to England, to UK.
Yeah.
So you may can answer this kind of questions. Naren, are you there? Has he gone?
I've asked him to unmute.
Yeah.
Is he trying to unmute himself?
Yeah.
Naren?
He's there. I can see him.
Can you hear me?
Yeah, got you.
We can hear you.
Okay.
Naren, the question is, a member is asking if he inherits assets from his parents in India, can he leave it in India and deal with it separately, or is part of your UK estate? And you came from East Africa. You probably went through the sales process. Please tell us.
There are advantages of leaving money in India because the Indian bank gives better interest rate than what we get here. But at some stage, you need to use that money. So when you talk to us, we're going to say, what is your objective? not today, but in 10 years, 15 years, so on. Parents have earned that money. It is for you. Well, you got to use that money in some way. Now, we encourage a lot of our clients to bring the money across from India to here. And to do that, there is no tax for you to bring it to the UK. There's no tax you pay here. The capital comes, £1 million comes into your bank account here, fine, not an issue. But then that money, what we do with that is to create further wealth from it. Whilst it's sitting in India, it can earn interest. But once the parent is, they're no longer there, yeah, it becomes part of your inheritance liabilities and so on. So these are the situation that we need to talk to you individually. Is more about you individually, what you want to achieve. And this is where the professional advice come in. See, every one of the 50 people who joined today, they all have a different situation. Their expectation, their state of life and everything. So there are considerations that we have, maybe 20, 30 different considerations for each advice that we give. And this is where the personal advice matters. And I said to Raju that one thing I do want to mention to the group here is, look, we all attend so many Zoom meetings of different kind all day long, and after 2 hours, it's all forgotten and gone, and not much happens from that. I think there's a danger that today we had this conversation, and I believe all of you should take advantage of this amazing connection Dr. Raju has connected with each other here. Get used to talking to us. There's no cost. Pick up a phone, chat, talk. So there's no cost to that. This is what we're offering the members. We are here as your advisory group. We are here to serve you. We're here to work with you for many years to come. And we create relationship. So if you now got Ajay's ID and email, for God's sake, email to him so you're connected. We have Fairstone have magazines that we can send it to you automatically every other month. So you're now connected with us and get benefit from us. No charge for that whatsoever. And I think take advantage of that. Today, you spend 1 good hour here on this Zoom meeting. That's a contribution you made. I believe you will get absolutely brilliant advices from us. I do advise people on Indian assets. What should you do with it? How do you make most of it? What should you be doing there in India? We have connections in India. We come up with a joint venture, and we may be able to develop the assets that you have. You may have a land, you may have a property. What do you do with that? So this kind of advice, we could give you that. What Ajay covered is very much regulated financial services business. But outside that, there are a lot of consultancy work I specifically get involved and do. And I would love to share that with you. 46 years in the business. This is all I have been doing over the years. I am more of an entrepreneurial businessman. I think like a businessman. So I happen to be a highly qualified financial advisor, of course, and which I am even today, but you're talking to a businessman. When you speak to me, I'll think differently. I'll go out of the box and we'll come up with solutions. Our job is to find solutions specifically tailored, designed for your specific needs and circumstances. Your circumstances are so different to anybody else's. And by the way, it's all confidential, of course, it needs to be. So our first terms of engagement is confidentiality. And we would maintain and preserve that, of course. That's the only way to do business. Our business is just like yours. Medical information and so on is confidential matters. And same with financials. If we are lucky, people trust us once, and then we work with them over the years. So I say a few words, and this just gave me the opportunities to express my thoughts. Thank you, Raju.
Thank you, Naren. So again, I appeal to you. I think Vishwanath, there are a lot of people like you in the audience. Please contact Naren and Ajay about how to deal with your assets outside UK. It's very important. There are 14 questions, so I move on. Next one from Prabhagar. Prabhagar, is that a question or statement? Are you there?
It's definitely a question. Do you want me to answer that very quickly?
Okay.
Yeah, a few people have asked that same question. Sorry, Prabhagar, are you there?
Prabhagar?
I don't think he's here because I tried to search him up.
Yeah, go on,
Okay.
Ajay.
So Prabhagar has asked the question, the nil rate band, does it consider all estates, everything within the estate? Property, ISAs, jewelry, everything. Yes. So just to be clear, as far as how the inheritance tax process goes, at the point that you die, the executors of your estate, the people managing your estate, they have to do a full inheritance tax calculation as part of that process. So before any assets can be released to the beneficiaries, they have to do an inheritance tax calculation and submit that to HMRC. So that would include all of your assets. So jewelry, worldwide assets, land in India, whatever it is, ISAs, investments, other than joint assets, which obviously are passing across. But if those joint assets are joint with anyone other than your wife, your spouse, sorry, then they must be included inside the calculation. So basically all of your assets.
Thank you. Thank you. We have 100 people in the audience today. Congratulations. I think 6 left, 94 still there. Please share your email. Put your email on the chat box and share with Ajay. And I move on to next one. Naz. Naz, is that Naz? Are you there? Well, the question is, my limited company invests to buy to let. How do we plan for future to pass money to kids? We are in 50s, yeah.
Yeah, Naz, that's a very simple question with an exceptionally complicated answer because there are so many moving parts and variables to that. So I'm sorry, I don't mean to divert from your question, but I would literally have to spend an hour talking to you and understanding your circumstances to really give you a proper answer to that question.
Okay, so
because there's no one size fits all solution for something like that.
Okay, so next is Sivaraman Kumaravel. Are you there, Sivaram?
Yes, can you hear me?
Oh dear, you have changed. Eh?
I'm saying the Raj.
That's what COVID has done to you.
Yes, isolation and pandemic, you know the effect.
Okay, what's your question?
Quick question, Ajay. Lovely presentation, really clear.
Thank you.
You talk in our language, basically. That's nice. The 7-year rule you said. Is there any formal paperwork arranged before you do it? Or you just transfer the money to your kid to buy the apartment and live 7 years and nothing more?
Very good question. So we always recommend that you have some sort of audit trail, more than the bank transfer, just to make things easier should you die within that 7-year period. Okay. So again, if we're working with you, Sivaram, then we would be documenting all of that because obviously as part of the ongoing IHT planning,
sure,
you would be telling us, look, I'm planning on doing this. So we would document that. It's all there. There's an audit trail. So HMRC then can't do any play stupid games with you.
Okay. And any limit on that? How much you can do in the 7-year rule?
No, the only thing to be aware of, obviously, is that you are using up your nil rate band, your £325,000. So, anything that's inside of your, if you die within the 7 years of making the gift,
yes,
then it's back inside of your estate and it's eating into your 325,000 allowance.
Thank you. I'll get in touch with you, definitely. Thank you.
Great.
Yeah.
Thank you.
Kumaravel is as simple as that. We all do NHS paperwork. Your date and time first and goes on. Same way to everything. In UK, everything documented. Thank you.
Thank you, Raj.
Next one is Madan. Are you there?
I'm here.
Okay, what's your question, Madan?
That was the same question, that the 7-year clock.
Okay, right.
It was the same question, partially exempt transfer. When can you start doing, and that it eats into your the nil rate balance.
Okay.
Yeah, I think the only thing I would just add to that, Madan, is if you're also incorporating trusts, then that has a knock-on impact with partially exempt transfers. So that's just something that, again, you need to get advice. Before you start making gifts, talk to us, because we can advise you on the best way of doing it.
Okay, right. Perfect. Thank you.
Thank you.
Thank you.
We move on to Tamilarasan Ambalavanan. Tamil, are you there? Please unmute.
Yeah, I'm here.
Okay. What's your question?
Yeah, the implication of discretionary will trust, does it have any implication on the nil rate band?
So it depends on how thank you for your question. It really depends on how the discretionary will trust has been written, because there's different forms of them and what the intention was for it. So one of the key things that I highlighted there was that if you're using the discretionary trust as a way of using up the nil rate band for your property, your main residence, then that can have a negative impact on the residence nil rate band. So effectively, by having some of your property on death moving into the discretionary trust, what you've effectively done is you've lost 175 to 350,000 pounds worth of residence nil rate band.
Okay. Thank you. Your presentation was very clear and nice. Thank you.
Wonderful. Thank you. Thank you.
Thank you. Shalini. Are you there, Shalini?
Yeah.
Oh, yeah.
Excellent presentation, Ajay. Thank you.
Thank you, Shalini.
Our question is, if we gift non-residential property to our children, what would the capital gains tax implication be? And would it fall into the 7-year rule?
Yeah, so the way the taxman looks at it, when you're giving a property away other than your main residence, the taxman doesn't care whether money has changed hands or not. They see that as a disposal for capital gains tax purposes, even if no money has changed hands. So let's say you bought a property for 100,000, it's now worth 200,000, and you're now giving it away at the point it's worth 200,000, then there is 100,000 capital gain that the taxman would expect you to pay capital gains tax on. So that's the first issue. So again, need to get specific advice on that. But secondly, that gift is still counted, or the value of that. So let's say in this case it's £200,000. That £200,000 is the value of the partially exempt transfer for the 7-year rule.
Thank you.
Thank you, Shalini. Next one is Vijay Sahadevan.
Yeah, hi Ajay. Very
Hi,
well
Vijay.
presented. I got the additional question while I posted that question.
Okay.
So the second question will be easy. I'll ask that. So do Fairstone offer will writing service and the lasting power of attorney?
Yeah, so we don't directly employ will writers, but we have a panel of vetted will writers that we will refer to. So if our view is that we're not going to force that on you. If you have a will writer you want to use, we will work with them, because there will be things that we will be instructing them to do that because we know about you. But if you don't have a will writer and you want me to introduce you to one, then we would do.
Excellent. And the question I asked on the forum was, we have a buy-to-let property, we jointly mortgage it. Is there a tax benefit if I transfer half of that, my share, to my wife? Because I'm currently paying more tax because of the rent, you know?
Yeah. So you're a 40 or 45% taxpayer. You're getting clobbered on the, if your wife is your wife's not working or she's not a doctor.
No, she's on the lower band, so she's not a doctor. Yeah.
Yeah, fine. So as long as the rental income is going to keep her within that lower band, then it would make sense to do that.
Okay, thank you.
Yeah. And by the way, there's no capital gains tax between spousal transfers.
Yeah, that's good news.
Okay, thanks. Yeah. Next is Ram to everyone. Ram.
Hello. Hi. Thanks for your time and your presentation. Two things. One is my parents hold shares in Indian stock market. I mean, the value is much below 325 at the moment, but the way the market is going, if it crosses 325 and if I inherit the shares, will I be will I have implications? I don't think I'll cross 325 in my lifetime, but just in case if it crosses, if I inherit those shares, will I have to pay inheritance tax? My parents, those on the share, that value.
And so your parents, where do they live?
India.
Okay, so they're Indian residents.
Yes.
Yeah, so it's the Indian tax rules for when they die.
Right.
Yeah, so there's no inheritance tax in India as it stands right now.
My name here in UK, do I have to pay?
Oh, sorry, they're in your name.
No, in my parents' name, but I am the, what you say, in India when they open account, who is the kind of next, they say in case of death, it will come to me after their lifetime.
So, okay,
do I have to pay inheritance tax on those money?
No, because it's it's not your money at the point that they die. It's their money until they've passed away. Yeah. So you've only got the shares once they passed away. So because they are they are Indian residents and it's an Indian asset in India, it's the Indian tax rules that will apply. So there's no inheritance tax in India, as far as I'm aware.
Yeah.
So Ram, can I make it clear? You live in UK and you're talking about your parents in India holding shares and you are the nominee.
Yes, I'm the nominee. Yes, that's right. Yeah.
Right. Okay.
Yeah.
Okay. And the second question is, in UK, if I've invested some in EIS.
Okay.
And if I cross 100,000 here, will that EIS protect me for the personal allowance loss? Say, if my income is 110,000, if I put 10,000 in EIS, will it protect me from that personal allowance loss?
Yeah. So the way it works is with EIS, you're just at the point that you make the investment. So have you made the EIS investment already, or you're planning on making?
This year I've made some. Yeah.
You've done it this year in this tax year.
Yes.
Okay. Have you received the EIS certificates?
I'm waiting one. I got one. Yeah, I've made 2 investments, but one.
Okay. So when you receive the EIS 3 certificate from the provider, then at that point, you then send that to HMRC, and there you actually say on the form which tax year you want the tax relief to apply to.
Yeah.
So either the current tax year or the previous tax year or both.
Yeah.
So, and let's say, for example, you made a £10,000 EIS investment. You are entitled to 30% tax relief on that.
Yeah.
So you're going to get, effectively, the taxman will give you £3,000 back.
Yeah. But will it save me from my personal allowance as well? What I'm saying is, say...
Yeah, well, it's effectively the way that the personal allowance works is the personal allowance is done, it's two concurrent systems. Yeah. So because I take it you're an NHS employee?
Yes.
Yeah. So the payroll system, the PAYE system, won't take into account that automatically. So what will happen is things will adjust by virtue of the fact that you're getting a rebate through the EIS.
Right.
Thank you.
Thank you, sir.
Next one is Jonathan. Jonathan, are you there?
Yeah, hi there.
What's your question, Jonathan?
Yeah, thank you, Ajay, for a great talk. I just had one question. You mentioned, I'm here for my mum and dad. So you mentioned at one stage with the 325 nil rate band and then the RNRB, which is 175. Is that per person? Because you came up with £1 million figure. So it's for each. So the totals is 1 million. That is nil rate band.
Yeah. So the way you've written it in your chat, in the chat there is absolutely spot on, Jonathan. So it's per person, but obviously it only works per person if you're transferring that allowance to the surviving spouse. So if dad passes away first and he's leaving everything to mum, then mum automatically inherits both of those allowances. So then that's where the £1 million comes into effect. But obviously you've got to bear in mind that the residence nil rate band only applies if the property is worth 350 at that point.
Okay, fine. Yeah. And then so they have, so if two parents want to pass it on to children, that allowance, that's a £1 million pot. Is that loosely right?
Yeah, correct. Yeah. But bear in mind that if the property is worth more than 350, then you're not necessarily getting a full £1 million on it, if you see what I mean.
Okay.
Yeah.
Fine.
So that's the bit where, again, if you want, get in touch. We'll run the calculation for you.
Yeah, absolutely. I'll send you my email. Thank you very much.
Great. Thanks, Jonathan. Thank you.
Thank
Cheers.
you. Thank you. I think next one is Nas. Nas, I think it's a bit difficult to cover your question. You can ring Ajay one-to-one communication, or you can ring him later on. Next one is NR1. NR1.
Raju, it's me.
Oh, it's
It's only me, your ghost.
when did you change to NR1?
Well, every week I change, like in running away from HMRC. Hello, Ajay. Thank you so much for giving us your time.
Thank you.
On the Saturday morning. You know, I have two questions. One is, if grandparents sell their property in India, are they allowed to give 250K each to the grandchildren in the UK without any tax liability?
Okay, so grandparents, they're in India, they're Indian residents?
Yeah, Indian residents, Indian property, and rather than giving it to their children, but then we will end up paying tax, can they bypass the children and give it to the grandchild? Like my children.
Yeah. Where is the 250,000? Where is that number coming from?
Well, you know, if they sell something, I thought they have a ceiling of up to 250K a grandchild can get from the grandparent, from an Indian grandparent to a UK grandchild.
Right. So, okay, just wanted to check which allowance you were referring to there. I believe that's correct. I think there are some individual circumstances. So, is it Rajeshri? Is that right? Did I get your name right?
Ravi.
Sorry, Ravi. So Ravi, or NR1 as you're calling yourself, the taxman today, probably best, why don't we have a separate chat about that, and I can ask you some more questions and I'll give you a more specific answer.
Okay. And second question is, say if you have a policy which has come to maturity and you want to cash it. Now, is the money which you get from the company, insurance company, dependent on how much lifetime allowance you have used already, so that you end up paying tax at the end of that maturity period for that amount?
Are you talking about a life assurance investment bond?
Yes, not a bond, like a policy. Yeah.
Yeah, like, so it's
like
you
a
said
Scottish Provident or whatever.
Right, but so it's an investment plan through one of the big insurance companies.
Where say the maturity is about 100K, and you think you're going to get 100K after 25 years, but the root shock is with your HMRC, and because you've used up your lifetime allowance, then you pay tax on that maturity amount.
Okay, so when you're referring to the lifetime allowance, is that because you've been taking regular withdrawals from the plan,
Yes.
5% withdrawals?
Yes.
Yeah. Okay, so the first 20 years of income from there is treated as 5% tax deferred. So you have a 5% per annum of the initial investment amount that you can take tax deferred. So let's say, for example, you invested £100,000 20 years ago, and you've been taking £5,000 a year income. So that's your 5% used up each year, isn't it? Assuming you didn't take any more than that 5% on a cumulative annual basis, over that 20 years, you've had a return of your capital, haven't you? You've had 100,000 out.
Yeah.
Let's say the plan is now worth 120,000. So what the taxman would now be looking at is to say, at that 20-year period, the end of that 20-year period, if the plan is worth 120,000, you've effectively got a £20,000 profit that you've realized. So that 20,000 profit, they add that on top of your other income in that current tax year. And if you're a 40% taxpayer already, then that bit there, as long as it doesn't take you into the 45% tax bracket, then you've got it's liable for up to 40%. However, if it's an onshore investment as opposed to offshore, it's already deemed to have paid 20% tax internally. So what you then do is you only have another 20% tax to pay on it. However, if you're not cashing it in yet, there are potential ways of mitigating that tax by assigning it to other people. So that's a very long-winded answer, but Ravi, get in touch with me.
Sure. But who does this calculation? The insurance company or the accountant?
Well, all the insurance company will do is will send a chargeable event certificate at the point that you do the encashment. A copy of that goes to HMRC automatically.
Yeah.
So you have so your obligation is to obviously declare it. But as I'm saying, before you do anything, there may be ways of actually avoiding that tax by doing a few bits of planning. So just let me know.
Sure.
And yeah, thank you.
Okay, thank you. Next one is Velu Chandran. Velu Chandran, are you there?
Yeah, I'm here. Can you hear me?
Yeah.
Yeah, I mean, very, very clear instructions and explanations, Ajay.
Thank
Part
you.
of my questions were answered by Ram and Ravi.
Okay.
I mean, my understanding is if I invest money in India, for whatever money I earn there, I have to declare it in UK and I have to pay tax on it. The only difference is that if I invest it in India, the income I get is going to be more because of the interest rates are more. Am I right?
Yeah, that's correct. Now there are dual tax treaties, so you should never pay double tax.
That's right.
So if you're paying tax in India, then as long as it meets this, for example, if you're so it balances out. So you shouldn't pay more than you should be. But yeah, you have to declare it on your tax return.
Like that, like Ram asked, you see, if I have the property of my parents' property, if I sell it in India and convert that into a British pound and bring it to UK, I will have to pay tax on that, won't I?
Well, there's capital gains tax due on the increase in the value of the property.
No, it's not there's no capital gains tax in India. Right?
I know, yeah.
Right. So I sell the property for 100,000.
Yep.
I bring the 100,000 to the UK. I will have to pay tax on that. Oh no.
No, because if you've inherited it, it's just inheritance.
Inheritance. I see.
Yeah.
Okay, right.
Yeah.
Thank you.
Okay.
But maybe, Chandran, when you give that property under 100,000 pounds to somebody else, then they will inherit tax.
You will get it then.
Thank you. Okay. Next
Thank
one.
Thank you.
Ram again. Have you got another question, Ram?
No, I think by mistake, I think it was.
Yeah. Okay. Who is next? I think there's a question from Vishwanath. Can we write our own will? I think the answer is yes, isn't it?
Yes, you can. I wouldn't recommend it.
Okay. Right. We'll move on. Asha Ravi.
Yes, I'm here.
What's your question, Asha?
My question is, if one has a joint account with one's son, how does it work out for inheritance tax purposes later on?
Okay, thank you, Asha. So at the point that you pass away, because it's a joint asset, your son automatically takes over the investment or savings plan, whatever it is. So that's the bit in terms of dealing with that. But as far as the inheritance tax calculation is concerned, 50% of the value of that is yours. Yeah. So let's say, for example, you have a joint account with your son, and that joint account has £100,000 in it. Yeah.
Okay.
So the assumption is that you own it 50-50. And so as far as the inheritance tax calculation is concerned, £50,000 is what's included in your estate.
Right.
However, if you have gifted that money to your son, that other 50%. So let's say you put £100,000 into a bank account, a joint bank account with your son today.
Okay.
If you die within 7 years,
okay,
then the full £100,000 goes into your estate for inheritance tax planning. Sorry, for inheritance tax calculations.
Right.
Yeah.
Okay. But otherwise, 50% of it, say one dies after 7 years after the joint account is set up, 50% of that is counted towards your estate for inheritance tax purposes.
Correct.
Right.
Correct.
Thank you.
Thank you.
Thank you very much.
Okay, good. Do you see any more questions, Ajay?
Yeah, Themozi, he's asked this question. Yeah. How much minimum can be put in the trust? Hi, Themozi.
Yeah, Tenmuli is here.
Temuli, am I saying your name right? Sorry, apologies.
Tenmuli, ten is a honey. She has a honey language.
The sweetest lady here today.
Yes, she's the sweetest one.
Okay. You see, I've got my father's charm. So in reality,
she has to unmute and say.
Hello, Ajay. Thank you for your clear and very straightforward presentation. I really learned quite a bit. Thank you.
Thank you. Sorry to give you a headache on a Saturday morning. So the simple answer to that question is there is no minimum amount that you can put into a trust. The practical answer is if you are doing investments and you're putting proper monies into trusts and creating structures, normally the minimum is going to be £10,000 because a lot of investment providers won't look at anything less than that.
Thank you.
Right, Ajay, I can't see any questions in my chat box. Can you?
Jane's iPhone have had their hand raised up for quite some time.
Ah.
So I'm assuming.
Okay. Can you see any more questions, Ajay, in your screen?
I don't think so.
Right. So I think you've done a wonderful job. As I said, you attracted 100 participants today, and we had a lovely discussion after that. I once again appeal to the members and audience, please get in touch with them, exchange your emails, and then he'll be ready to provide any explanations you're asking for. Thanks for everybody coming. Thanks for the committee members. Thanks for the co-host. And thank you, Ajay, and your dad. You've done a lovely job. Hopefully we'll meet in Leicester, May 2022.
Looking forward to it. Thank you.
Thank you all.
Sorry, was there another question? Someone had their hand up?
Oh, it was Jane's iPhone.
Jane's iPhone?
Oh, yes. Oh, it's Naga. Yeah.
Naga, hello.
Oh, right. You're nearly at the end. That was a nice talk from Ajay. Ajay, just one little question. You mentioned if you don't have a will, right, so much goes to spouse and the rest goes to the descendants, you see.
Correct.
Am I right? How does that work out if you don't have a will?
So basically, if you don't have a will, then the law of intestacy applies. And
Right.
that is where, so any joint assets go to the surviving joint owner. So let's say, for example, you have a property or your main residence,
Yeah.
owned between husband and wife. If the husband passes away, then the wife just automatically gets that asset, no problem there.
Yeah.
But then the next £270,000 on top of that also goes to the surviving spouse.
Right.
So let's say, I'm just going to keep the numbers simple. Let's say, for example, you have a property that's worth 400,000 jointly owned between husband and wife. Yeah.
Yeah.
So that is now going to the surviving spouse once the first spouse has passed away. Now, other than that, the couple have I don't know, let's call it £300,000 in other assets.
Right.
Just to keep the numbers simple. The first £270,000 is going to go to the spouse.
Yeah.
And so from that 300,000, we've just taken 270 out. We've got 30,000 left.
Yeah.
That 30,000 is split 50-50 between the children and the spouse.
Oh, that's split 50-50 between the
50-50.
children.
Yeah.
Yeah.
So you can see there that the problem is that we're not fully utilizing the nil rate bands.
If you have two children, it's split three ways? No.
Yeah, so it would be split 50%. So 15,000 would go to the wife, and then 7,500 to the two children.
Right. Do they have to pay tax on it, children?
Only if there's inheritance tax payable. So in the case of, good question. So in that circumstance, because not everything is passing to the wife, to the spouse, the actual test is the only test that's coming, the only allowance that's being applied there is 325,000.
Yeah.
Now, so the first 325,000 out of all of that is tax free. So effectively, the amount going to the children above the 325,000 global amount, they would pay 40% tax on that. Yeah.
Right.
So effectively, there's a fair bit of tax being charged there. Whereas if you just had a will done and you said in the will, I want everything to go to my wife, and then the wife can distribute as she wants to during her lifetime, then there would have been no inheritance tax payable in that circumstance.
No, but at the end, the wife's got to distribute it as well at some point, isn't it?
Yeah, but on the assumption that the wife is distributing during her lifetime and she's used up her own allowances and everything else.
Oh, okay. Yeah. And whoever inherits, they'll be paying the tax anyway.
No, the estate pays the tax.
Oh, the
estate pays the tax. So you can't distribute the assets until the tax is paid. That's the really key bit with this.
Okay. Yeah. Okay.
So for example, if you have a lot of properties, a lot of people, they have investment properties, they have all sorts of things, that you can't touch any of that until the taxman's had his money first.
Oh, yeah.
And the reality is the taxman would either expect you to go out and expect the beneficiaries to go out and borrow large amounts of money, if you can actually borrow it, or you'd have to essentially, in a fire sale situation, sell the properties to then pay the taxman.
So taxman, if there's no executor, taxman becomes the executor, does he?
No, there is always whoever's left behind, they would have to assume the role of an executor if one hasn't already been appointed in the will.
Yeah. Oh, thanks so much for that.
Thank you.
Thank you. It looks like a lot of questions from most of the members. So I once again I appeal to the members to exchange your email ID. I think some of them have done it, and the others, please do before you go. If not, it's not an unreasonable thing to do is to share your emails to Ajay, and then it may be useful to you at some point. Any more questions?
Raju.
Hello.
I just wanted to thank you for organizing.
Arun, before you start, we want to know the your value of your estate.
we have a special plan for billionaires. Talk to me later.
Go on.
Very well. Just after the cricket match is over. Very well done.
Okay.
Just one question about the SIP, self-investment pension plan. Initially, when we started, they said that you can transfer some percentage amount to your children without paying any tax. I don't know what percentage it is.
Right. Arun, that's a really good question. I didn't go into that level of depth in my presentation, but I'm glad you have asked that question. So pension assets generally are outside of your estate for inheritance tax. Yeah, but let me qualify that. So if you've got a SIP in your circumstance, so personal pensions, SIPs, etc., before the age of 75, the money goes to whomever you've nominated on the pension. So when you set your SIP up, they would have asked you to complete a nomination form, a death benefit nomination form. So on there, you may have, for example, written your wife, my children, whatever. So if you die before the age of 75, it will go to those people free of tax. Okay. If it's after the age of 75, then if your beneficiaries are encashing the pension, so let's say I have said that I want my money to go to my wife and my 2 kids split in a certain way. After the age of 75, if the pension is now cashed in, then the amount that person, the beneficiary, receives is taxed as if it was income of their own in that tax year. So let's say, for example, now you passed away after 75, and your wife is, sorry, Auntie, I don't know your name. I'm just calling you wife. Nirmala, brilliant. So let's say, and we know you're a billionaire, Aruna, and so let's assume that you've got £1 million. Let's say you've got £1 million in your SIP, and now Nirmala, you've died after the age of 75. So now you put on your nomination form, I want Nirmala to get 100% of this when I die. Yeah. So Nirmala now, she is now receiving £1 million. Okay. If you died before the age of 75, not a problem. Now you've died after the age of 75, Nirmala is going to pay 45% tax on that £1 million. Now, the way around that is that you have something called nominee and successor death benefit nomination. Now, depending on when you set that SIP up, your SIP provider may not necessarily give you the ability to have that nomination. So what we always do when we're meeting clients who've got pension schemes, we do an audit of your pension schemes to ensure that they are compliant with the very latest regulations. Because given the choice, rather the way of getting around that 45% tax charge in this example is Nirmala actually just takes the pension over in her own name. So she's not cashing it in. It's now her SIP as opposed to your SIP, Arun. But that is only possible if the pension scheme gives you that option. So we need to check that.
What if both the spouses have SIP?
That's okay, because as long as the pension scheme, the SIP provider gives us the right ability, and as I say, we would check very quickly to see whether it does, you just nominate the children. So effectively then the children can inherit and take over your pension schemes as pension schemes in their own names. So pensions actually are very good for cascading the wealth down the generations.
So do they pay, do the children pay 45% tax on it? Or is it like they're inheriting it without paying any tax?
So if they take it over as a pension, so, let's say it's Arun's pension today, or it's Nirmala's pension. Now Nirmala's passed away. It's now Nirmala's son's pension. So Nirmala's son now has his own pension, which was yours. It's now his. Okay. Yeah. What you have to just be careful of is that there is a lifetime allowance issue as well. So that does come into play. So as always with these things, there's not a simple straight answer. But if we can get in touch and I can look at what you've got, I can let you know what the best way of dealing with that issue is.
Okay, thank you.
Thank you, Ajay. Thank you, Shanmugaraj.
Thank you, Arun.
Hello, Raju.
Hello.
Vijay here.
Vijay, yeah. What's your question, Vijay? Nice to see you.
Nice to see you hosting this seminar.
Okay.
I want to ask Ajay, in discretionary trust, can we add in more money to it? Say it was opened 2 years ago. And does the 7-year rule apply to the discretionary trust?
What kind of discretionary trust is it? What have you put in it so far?
We've put in our, we had a rental property in London. We have put that in. So can we add on, say, more cash into it, like without affecting our lifestyle? And does the 7-year rule apply from the time we put in the cash or when we open the trust?
Okay, it's a really complicated one. Properties in trusts are fraught with difficulties. So Vijay, I really think you should get in touch with me and we should talk about that. But the other issue with discretionary trusts is that they are subject to an initial inheritance tax. It's called a chargeable lifetime transfer. So depending on the size of the gift, we have to look at what other gifts you made and other chargeable lifetime transfers you made in the previous 7 years, and it adds to the cumulative £325,000 of that trust. So it might be better to set up a brand new trust, which benefits from its own individual nil rate band. That's normally the way to do it, rather than adding to the same one. But I would very strongly urge you to get in touch with me, because there are probably some tax implications that you're not aware of by having that limited, by having a rental property in a discretionary trust.
So it's better to form a new trust to put in, say, more cash in rather than put in the already existing trust.
More than likely, but there's a lot of variables there.
And the 7-year rule applies to the time you open a new trust.
Yes, it does, but because it's a discretionary trust, there is an additional set of rules called chargeable lifetime transfer rules, so there's an added complication there. So again, we've got to understand what you've done previously and how the last one was set up to then advise you in terms of how to best do this one without avoiding any initial inheritance tax implications, because there may be an initial 20% tax implication.
The £3,000 gift that we give to our children, can then be backdated to last year or not?
You can carry forward 1 year.
And is it for each one of our, me and my wife, or for one household?
Yes. No, it's per spouse. So you got 6,000 this year, plus if you didn't use the last year's allowance, then it's 12,000 in total.
So how do we document it, like in the banking statements?
Yeah, you can just have a log. You just put a note together, and you can add that to your will, or if you have a financial advisor like myself, we would have an automatic audit of all of these things. So when it came to the point of death, we can then demonstrate exactly what's happened and when.
I've got a joint property with our friends, and it's a company shares. How does that work into the inheritance tax?
So if it's investing into is it a private limited company?
Yeah.
Yeah, as long as you've held those shares for 2 years at the point of death, then those shares are outside of your estate, on the basis that it's a trading company, not an investment company.
So if I had, say, 100 shares more than 2 years ago, and I've bought some more shares, and that the 2-year rule will apply.
Correct. Is it a trading business?
Yeah.
Yeah.
Thank you very much.
Okay, thank you.
Thank you. I think there's a question from, I can't see the name. Can investment trust at maturity be converted into inheritance tax payment vehicle?
Okay, investment trust as in, I just want to be clear with that. Can whoever's asked that question, can they come up on stage? Hi there.
Hi, it's
Hi.
Partha. I asked the question.
Partha, right.
Okay, Partha, when you say, let me just double check. When you say investment trust, do you mean a specific fund, an investment trust fund?
Yeah.
Like a listed investment
actually,
trust.
You set up an investment trust for, like you said, 100,000, and after 20 years, you have drawn out the capital and the profit that you have. Rather than being taxed, you can convert that into a part of the investment paying vehicle.
Okay, so Partha, this is an investment bond as it stands right now.
Right.
Yeah. Okay, so it's not already written under a trust structure.
No.
Okay. So yeah, you could assign it into trust, but there could be some initial tax implications in doing so.
Right.
Yeah. So I would need to understand a lot more of your personal circumstances to give you an answer.
Yeah, the specific thing is, but say if you put 100,000 in an investment trust, which is actually you draw 5,000 every year, without tax liability, and at the end of 20 years, you don't, you got whatever over and above. At that point, rather than taking that profit and paying tax on that, can you convert that into a investment vehicle to pay for the IHT liability?
I think the difficulty is you need to get that to make it IHT friendly. It needs to go into a trust.
Right. Okay. Okay.
And to do that, there will be some initial taxation implications which we would need to just mitigate.
Right.
So
can you do it now? I mean, when you set up, say, for example, next 20 years, I mean, can you do it now to preempt it in 20 years' time?
Yeah.
Right. Yeah. Okay. Okay, that's fine.
And it also depends on what else you've been doing in the last 7 years. What are you planning on doing in the next 7 years, etc. So there's a timeline that we would need to put in place because there's lots of knock-on implications.
Yeah, sure. Does VCT qualify for BPR?
No.
Only EIS.
Only EIS.
Okay.
I know it's a shame, that one, isn't it? But that's why, to be honest, these days we're not really recommending VCTs because you get better tax breaks from EIS now than you do from VCTs.
Right.
And actually, they're less risk.
Right. And I mean the seed EIS also work the same way, does it?
Seed EIS, yes, but you get a higher level of tax relief on a seed EIS compared to normal EIS. So you get 50% as opposed to 30% initial.
Sure, but that is more risky, isn't it? Seed EIS is more risky?
By the nature of the fact that you're investing in startup businesses as opposed to ones that have already got some track record.
Yeah, sure.
Yeah.
Thank you. Yeah. We'll be in touch with you Ajay.
Thank you, Partha.
Yeah, I think Partha, you can directly exchange your email with Ajay. There's a message from Shalini. She says that I have exchanged my email directly to Ajay. So there's still 57 members there. Please exchange your email to Ajay directly, and then you can have an email chat later on. Dr. Sivalingam.
Yes, I'm here.
Yeah, please ask a question. Yeah.
Which is actually a comment, really. First of all, thank you for the great presentation by Ajay, and thank you, Samaraj, for organizing it. Now, just his comment is on the primary residence relief for estate inheritance tax calculations. 175K per person, per couple is 350K. This is only available if the total estate value doesn't exceed 2 million pounds. Is it correct?
No, below 2 million.
Yeah. If the estate is valued, say 5 million pounds, for example, then they don't have this allowance.
No,
it's only available if it's less than 2 million.
Correct.
Yeah. Thank you.
And Sivalingam, by the way, what we would do is, through trusts, through gifting and various other things, we can effectively, over your lifetime, over 10, 20 plus years, whatever, we can reduce your chargeable estate down so that we can regain the residence nil rate band. There are ways of doing that.
Okay, thank you.
I can get in touch with you.
We'll get in touch with you.
Okay.
Thank you.
So Bolton, you get properties more than 2 million then, Siva.
Total, everything together.
Okay.
All your worldwide assets, everything. House, property, jewelry, whatever it is, cash, pensions.
Yeah. Okay. Thank you. There's a comment from Gogol. This is the best financial advice I ever had. Excellent talk. Well, thanks, Gogol. Just share your email with him. Ganesh, I have emailed Ajay directly. Thank you. Any more you can see? So it's nearing 2 hours. It's a very good session. I hope you and your dad enjoyed it.
Yeah. Well, thank you so much. I'm very, very touched and honoured to have had so many members join us today. I think clearly it shows that this is a problem that, as I say, that a lot of people suffer from. The good news is you've got some amazing specialists here. I'm not trying to be too big-headed here, but this is my bread and butter. I do this every day, as does Dad. And you have a team of over 600 people in Fairstone that you can rely on to support you in your endeavours and ensure that your hard-earned wealth goes to the people that matter. And I don't mean the taxman with that. But thank you so much for your attention. I really appreciate it. If you've got a headache, the paracetamols are on me. Have a wonderful weekend, everybody. Thank you.
Thank you, everybody. By the way, Raj, thank you for setting this up. We are absolutely delighted. It's a privilege to your friends, colleagues, friends. I feel friends with all the people, participants. And this is the beginning of a friendship and relationship we will create in years to come. And we are looking forward to seeing you all in Leicester in May 22. So thank you, Raj. I'm grateful to you, by the way.
Thank you. Okay, goodbye, everybody. The meeting is now closed.